having worked at Payne Weber, I was 100% on commission. So there were lots of fees that I could generate depending on which way I steered a customer. And that's what really started to leave a bad taste in my mouth in terms of just how I was going to function in the business. And then for the next 4 years, I went to work for the oldest bank in Texas. And I told them, I'll come to work for you, I'll do this, but I have to work basically on a salary. I think that the working on commission creates some conflicts of interest and bad incentives. I started reading about this registered investment advisor structure, and I just thought, this makes so much sense because this is so obvious that this is clearly a better business model, and yet it's taken every bit of 20 plus years for everybody to see, oh, the RIA model really can be a better avenue. But we took it one step further. First off, we're fee only. So if the relationship grows, we get a pay raise. If it shrinks, we take a pay cut. And we're also a fiduciary. So fiduciary is very, very simple and very straightforward. We are legally obligated to do what's in the client's best interest. So we're not going to hide behind legalese and disclosures. Quite simply, our job is to take care of people, to put their needs first and foremost. And, I always remember Charlie Munger's comments about that. If you show me the compensation structure, I can tell you the outcome of how people will behave. And so, very simply, put the needs of clients first, keep their expenses as low as possible, deliver good investments. It's a win-win all the way around. I learned very early on while I was still at the bank that wealthy people don't just have investment needs. We want to be the first phone call where they say, we need some help or some guidance. Can you steer us in the right direction?
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. After 20 years of investing, I've seen countless research tools come and go. But Fiscal AI is different, and it's become indispensable to my process. Fiscal AI is a modern data terminal built for investors who want institutional-grade research without the complexity. Whether you are a retail investor or managing a portfolio professionally, it gives you instant access to 20 years of financials, earnings, transcripts, and an extensive segment and KPI database, all in one intuitive platform. What makes it a game changer? Speed and depth. There are data updates within minutes of earnings reports, not days. Want segment revenue, subscriber growth? It's all there. Easy to chart, compare, and export. I use Fiscal AI daily to research my holdings, find new investment ideas, and deepen my analysis. It's fast, intuitive, and has genuinely transformed how I work. Use my link See episode notes for 2 weeks of free trial plus 15% off. Today, my guest is Dave Sather, certified financial planner and founder, CEO of Sather Financial Group, a $2 billion fee-only investment management firm based in Victoria, Texas, who has spent over 25 years building authentic client relationships through disciplined value investing, and is the visionary behind the award-winning Bulldog Investment Company student internship program at Texas Lutheran University. Dave, how are you? So nice to see you again.
Life is good. It's great to see you too.
We connected at John Michalczewic's MOI Global in Zurich a couple of years ago, and we've spoken quite a few times since. I know you listen to Talking Billions. I also know that you listen on the way to the class itself. Am I right about that?
Yes. Yeah. It's a great way to spend what would otherwise be dead time.
Good. I realize that we all have those hours here and there, and now podcasts fill in that gap. Instead of maybe doing other things, we can be productive, and I appreciate you spending that hour with me and my guests. I do have so many questions about your business, and I've learned quite a few things listening to you over the years. But I want to start from the early days. I want to hear about your childhood upbringing and how you think that time shaped you. How much would you like to share?
I appreciate you asking that question because I really do think it was formative. Both my parents were the product of the Great Depression. So my dad was born in 1932, my mom in 1933, and they were from very, very modest families. Both my parents were the first generation to go to college. And, being from Minnesota, the Midwest, they were very frugal, they were very humble, but they believed heavily in education. And when me and my brothers came along, they definitely instilled that ideology in us that it wasn't a matter of if we would go to college, but where. However, it didn't mean that it was just going to be something that was paid for. So every time we got money from a job, birthday, holidays, whatever it was, half of it was required to go into our college fund. And so from a very early age, we knew that the investment of college was an expectation, but my parents also wanted us to have very strong buy-in to make sure we took it seriously. The other thing, too, is that I did not grow up getting an allowance. Simply for being in the house, I didn't get a paycheck. My parents were really good about saying, look, if you want money, there's a yard that needs to be mowed, there's a house that needs to be painted, there were weeds that need to be pulled, and if we didn't like the rate of pay, we were welcome to go work outside of the house. And typically we would do both. I remember the summer I was 14 years old, I had 4 part-time jobs during that summer just to try and make a little extra money. Just because summer jobs were harder to come by and making money was really difficult. And but still, if you wanted to go do anything other than just sit at the house and stare at one of 3 channels on the TV, you had to go earn some money in order to be able to facilitate that. And of course, the more money we made, the more that went into our college fund. So, I would say that helped us to start developing a really healthy relationship with a work ethic. And if you work hard, there's money to be made, and that gives you flexibility in the rest of your life.
I like that perspective, and I like that you got to learn those principles so early on. And I like to ask that question because a lot of people tell me, the first job, the first role, but we learned so much even before we arrived at the first desk, at the first career step. And I like that perspective. You use the word investment instead of expense. And I've been thinking a lot about it lately. And I want to write an article about it, how there's a mindset shift when we see something as an investment instead of an expense, right? Even a service that we pay for. When it's an expense, we have a whole different attitude. But when we see this as an investment towards, our financial future or learning something, and college was clearly an investment for you rather than an expense that you have to cover one way or the other. You have a whole different relationship with it. I want to ask you about your business. About your business. So it's a $2 billion advisory firm in Victoria, Texas. And I must say, it's not Wall Street. And you decided to stay very local, and you turn it into your advantage and strength, building local relationships with people around you. Can you talk about that? I think it's a huge advantage that maybe it's not discussed about enough in this profession.
I would agree with you, and I will tell you that in terms of trying to attract young talent, there is that mindset of I've got to go to Dallas, I've got to go to New York, Chicago, Los Angeles, and I have to admit that when I was young, I wanted to go to Houston because that's where all the excitement supposedly was. But for myself, my dad was in the defense industry, and as a result, we grew up in El Paso, Texas, as far west as you can go in Texas. And my dad worked at a place called White Sands Missile Range. So when we talk about like defense systems, the Patriot missile system, my dad was the overseer of all their testing when that was all going on. But El Paso, again, is a big military town. It's not a Wall Street town, not at all. But then I went to Texas Lutheran as a student, and I got a phenomenal business education. And it wasn't about any fancy stuff. It was just the discipline, the fundamentals of it. And so I ended up moving to Victoria about 32 years ago. And that happened because I met my wife in college, and she is from Victoria, Texas. And when we were dating, I swore I would never live in Victoria because I thought it was too slow and, there wasn't all this exciting, the glitz and glamour of the big city. And so, for the audience, I would just say, be careful of what you say you'll never do because inevitably you will eat those words. But my wife, Carol, she had family obligations in Victoria. And it was very apparent that if I wanted to marry her, we needed to find a way to make it work in Victoria. But at the time, I was working in the energy sector in Houston. I already had my MBA. I had a great job, and it would have been really cushy just to stay exactly where I was. But I started trying to figure out how Victoria might work for us. And although Victoria had a really strong energy presence in the 1980s, at one point, it had the highest per capita net worth of any city in the country. But by the 1990s, Texas was in the midst of a really bad recession. Not only banks were collapsing, real estate was collapsing, and oil prices remained low for a decade. So that was the market that I was trying to come into. And at the same time, I knew nothing about the investment business other than one of my summer jobs. I worked at kind of a country club, and I used to wait tables for a branch manager of Shearson Lehman Hutton, which was one of the old brokerage houses. And at the end of the summer, he just said, I think you'd be good in the investment business. And he offered me a job as a stockbroker in Austin, Texas. And I have to admit my ignorance, despite having my MBA at the time, I'd never had an investments class. And functionally, I knew nothing about the investments business. And that was important in a couple of ways. My ignorance let me come into the industry with no preconceived notions or bad habits. So that was pretty good because I was a clean slate. But in Victoria, I found that there was a one-man office for Payne Weber, which is now a part of UBS. They hired me, and of course, then the real education begins. I cold called everybody in the phone book, and I was miserable. After 1 year, I just said, if it's meant to be, it won't be cold calling people. But I continued to come to the office. I would read, I would learn. But I also began to start observing. When you live in a small town, Victoria is a town of about 60,000 people, but it behaves like it's maybe 6,000. So reputation matters hugely. And I could tell that my bosses in New York, they were far more concerned about sell product, regardless of what necessarily might have been in the best interest for clients. And it became very apparent to me that if I burned local people in Victoria, my reputation would be tarnished and it would be extremely hard to recover. And so when I later read about Warren Buffett's comments about, protecting your reputation, and it takes, a lifetime to build a reputation and minutes to destroy it, I started to really see why that mattered so much. And about this same time, I started reading about this guy named Warren Buffett. And in time, I became so intrigued by his strategy and philosophy that I would call his office to get Berkshire's annual reports. And I'd read them over and over, and I'd share them with other people. And I'm sure most people just kind of thought I was crazy. So that was kind of my entry into the investment business. As for Victoria itself, we're 2 hours from San Antonio, Houston, and Austin. So you're talking about, Houston alone's 5 million people, Austin's a couple million people, San Antonio's a couple million people. So really large cities. But between them and Victoria, there's a bit of a geographical moat. And as a result, Goldman Sachs and JP Morgan, the big money center banks, they would love to have the clients we have today, but they're not willing to live in the community. And that's a big differentiator. So as our firm has grown and the need for sophisticated solutions has grown, the moat, the geographical moat, has benefited us tremendously. The other thing that people don't understand, I think, especially younger people, about life in a small town is my real estate costs are much lower and my commute is much lower. Not to brag, but my house sits on 10 acres of land overlooking a 45-acre lake, but yet I'm 2 miles from our office. As a result, I spend 0 time stuck in traffic. It takes me 3 to 4 minutes to get to office. And if I need to come down to the office to get something done, it's very easy just to pop in for an hour. And sometimes my wife doesn't even know that I left. So if my cost of doing business is lower and I'm not spending lots of time commuting, we can also offer more modest fees, I think, to people. So if the client gets better returns, that translates into higher asset values, and in the end, everybody ends up doing well financially. So now our firm has been here almost 27 years, and I think the reputation works very much to our advantage, even though it was a tall obstacle to overcome initially.
What a huge advantage. You said the time that you can spend doing something else, or just even with a kayak on that lake, thinking, and the cost advantage, but also it creates an actual physical distance from all the noise that you would have if you were in the middle of New York and you're pulled into all the events and conferences and everybody's smarter and everybody has something better to offer. It's very hard to sit down and do what Buffett has done over the last 50, 60 years. It's very hard. But you found that place where it works. I want to highlight something. We talked about investment expense, the difference. You mentioned what I would call transaction and a relationship. And so much of our world these days is organized around a transaction. You make a sale, you walk away. You make a sale, you walk away. And I have this image of a used car salesman, right? Obviously, huge difference in my understanding of how bad the car is, and the person who is selling me the car, they know exactly what's wrong with it. Anyways, there's stories about used cars. And it's a transaction. He or she wants to get rid of that car from the parking lot as fast as possible and will pull all the tricks possible to get that car moving. And that applies in many places. But then you have businesses and setups where you can turn that interaction into a relationship. And even, I think, let's take it as an example, you can have a used car salesperson that builds a relationship with your family in your town, and all the cars that you will buy for your kids, for yourself, maybe you will help your in-laws buy a car at some point, you will always go to that person. And that person built a relationship because they never sold you a total lemon. I think even those businesses where it seems like it's all transaction, you can turn them into a relationship. And the business we are in, what I value the most after 20 years in it is the relationships that I'm able to build with my clients and the people in the industry. And the reputation is something that takes years to build, and Buffett reminds us you can lose it in a heartbeat. But I see it as my life being just much more enjoyable, having relationships in my life instead of thinking of every single thing as just an individual transaction that takes advantage of one side over the other. Which brings me to the fee structure. And I want to highlight that a bit more, given how you operate. And there's so many different ways. You mentioned commissions, and maybe people forget, but traditionally, when you wanted to have an investment, you would pay a commission to a broker who had very different incentives than you did, and they would put something in your portfolio. Now we have asset management fees, performance fees, and even the performance fees are sometimes some complicated. I think it takes half an hour to explain how they really work. Anyways, you went about it in a different way. Tell us how you did it.
So having worked at Payne Weber, I was 100% on commission. So there were lots of fees that I could generate depending on which way I steered a customer. And you have to remember, that was in the early 1990s. So I had all the information, and if I chose to use it, poorly, I could steer somebody one way versus the other. And that's what really started to leave a bad taste in my mouth in terms of just how I was going to function in the business. I did that for about 3.5 years. And then for the next 4 years, I went to work for the oldest bank in Texas. And it was interesting. I was managing the investment program for their trust department, and I started their broker dealer. And I told them, I'll come to work for you, I'll do this, but I have to work basically on a salary. I think that the working on commission creates some conflicts of interest and bad incentives. And so I worked for them for 4.5 years, and then they wanted to put me on commission. And that was one of the many things I knew it was time to move on. And so I started reading about this registered investment advisor structure. And I just thought, this makes so much sense, such that when I told the bank I was leaving to start my own financial planning firm, I thought, okay, I might have a 3-year head start on the competition because this is so obvious that this is clearly a better business model. And yet it's taken every bit of 20 plus years for everybody to see, okay, the RIA model really can be a better avenue. But we took it one step further. First off, we're fee only. So if the relationship grows, we get a pay raise. If it shrinks, we take a pay cut. And we're also a fiduciary. So fiduciary is very, very simple and very straightforward. We are legally obligated to do what's in the client's best interest. So we're not going to hide behind legalese and disclosures. Quite simply, our job is to take care of people, to put their needs first and foremost. And if the relationship grows, we get a pay raise. If it shrinks, we take a pay cut. But that direct incentive is there then to give great service when clients call and need us, to do a great job on the investment performance, and to keep those frictional expenses as low as possible. And even though people think, oh, well, there are no commissions, I mean, I've never met a Wall Street firm that is a nonprofit. They are not charities. So there's still bid-ask spreads, there's market maker fees, they get order flow type benefits. So it's our job to know those things and to try and get the best execution we possibly can. And clients know that we are not getting a kickback under the table like many others are. So there's no free trips, there's no other things that would steer our behavior other than trying to put that client's needs first. You know, I always remember Charlie Munger's comments about that. If you show me the compensation structure, I can tell you the outcome of how people will behave. And so, you know, very simply, you know, put the needs of clients first, keep their expenses as low as possible, deliver good investments. It's a win-win all the way around. So in looking at how we serve people, I learned very early on while I was still at the bank that wealthy people don't just have investment needs. In general terms, they have needs that are in estate planning, tax planning, risk management, retirement planning, and then something else we just call big ticket items. So it might be a business, it might be a ranch, maybe an airplane, maybe a boat, anything that has a large price tag on it. We want to be the first phone call where they say, we need some help or some guidance. Can you steer us in the right direction? And we don't charge any extra for that. It's just value add. And I think we find that to be an intriguing puzzle to try and put together. And admittedly, no platform is perfect, but I think it's the one that probably aligns our goals the most with a client, recognizing there's always room for improvement.
Dave, you highlight something that's really close to my heart, and it's something that I realized very early on in my career. So I came to investing because I was fascinated with the intellectual puzzle that it presents, and I still am. But I was really touched and moved by the people behind the portfolios. And I realized there are stories, emotions, and there's a lot that comes with it. And learning who you're serving and how you're helping helps me have the context needed to do the investment side properly. And I think the two have to coexist. I don't think there's a perfect fee model in this business, but I think you found a way, and I'd like to think that I did too, that aligns the best I can imagine at this point in time with the client's interests. And we both know of many different models that just make it harder.
Right.
I know
Right.
that there might be angels out there doing things, but I think we are all humans. So if you can align those incentives in a way that serves both sides the best we can imagine, the better. And some models serve us better than the other ones. I want to ask you a big picture question. 25 years in investing. We're talking about Buffett. We're talking about what I'm hearing is very disciplined, patient, value-driven investing. There are moments when we're seeing a lot of momentum, a lot of speculation. How do you stay true to your principles through those times? And maybe it's a timely question, but it might be timely again 5 years from now. Who knows? Different market cycles, and we don't always look like heroes. How do you think about it?
Yeah, that is really challenging, especially when somebody comes into our world and they say, "Hey, my brother works with you, my sister-in-law works for you. We've heard good things about your rate of return." That always worries me because I know that the bar is probably set a little too high because inevitably, if we've had a really good run, there's going to be a step back. And so one of the first things we do is start trying to help them understand the downside of what can happen and what the time frame is to deliver the success that they are ultimately looking for. For myself, I've been in the game long enough to have experienced 2000, 2001, 2008, 09, the pandemic, and the current environment. And it's funny when you're talking to people and they say, "Oh, well, I hear you're a value investor. And so you're trying to buy cheap book value stocks." And, there's an educational process that comes along with that, that value investing is not an ironclad formula. To this day, people still think that Buffett does what Ben Graham did. And there's really a very interesting evolution of how he's changed. If anybody wants to read a really good research piece, Kai Wu with Sparkline Capital has written one about the different phases of how Buffett's career has changed. It's really good. I'm going to be using that as a teaching tool for my students to help them that we're constantly evolving under different scenarios. Recognizing the goal is to get the best return on your investment. That has never changed. But industries and technology and markets are constantly evolving. As such, you have to recognize how to find businesses and then ones that will understand a level of predictability and consistency that you actually have some knowledge in. And so helping people to recognize I may not have deep knowledge into a given tech company or maybe a biopharma company, and that's okay. I don't have to swing for the fence on everything. Rather, we're trying to say we will invest in things we understand that are predictable and consistent, but I've got to be able to buy it at the right price. And then I need the client to be patient for the appropriate time frame. And we show them volatility charts that says, the stock market has gained as much as 50%, 56% in 1 year. It's lost as much as 37% in 1 year. So if we're an investor for just 1 year, it can be a very, very bumpy ride. But when you get to the 5-year point and the 10-year point, all of a sudden the volatility starts to smooth out and you derive the returns that you're actually looking for. And so trying to paint that picture of what we are looking for in terms of quality and type of investments, and then the time frame needed for success, that's how I think we try and retain rationality in the world that we live in today.
Dave, so many thoughts are rushing to my head, so I'm going to pull in two threads. One, new accounts. And it's an experience that I continue to improve on that front, because having clients for a decade or two, it's a very different relationship going into a tough time. Because first of all, they might have gains from the past already, so they feel more comfortable. They're just giving up a little bit of those gains. A new account is a whole different experience. You're getting to know each other, and you're earning their trust. And there are two ways to go about it. All in, fully invested on day one. You don't want to miss a beat. It's a rising market, and you're hundreds of basis points behind if you don't just go all the way in. Or you pace yourself, and you pace yourself in various ways. I haven't found a perfect way. I found a way that I think works for me, works for my new clients, but it's something that I'm curious about. How do you think about new account, fully in cash? Here we are. And I'll ask you one more thing. Usually the timing is fascinating because those accounts show up when the market has done well for a long period of time. And this cash has been sitting there unattended for too long. And then they give you a phone call. I don't know why, but somehow those phone calls pile up right before we might have some sort of a pause. What do you do about it?
Yeah, I mean, you're 100% right. We have experienced the exact same thing. So people who have been sitting on money, all of a sudden it comes to us after there's been a big run up. Or maybe there's some sort of life event that they're getting cashed out. So we've got one client group that they're selling $35 million worth of real estate, and it will be life altering for the principals in this family. But they're so nervous about the valuation in the market. And so we will approach that a couple different ways. We have a very small number of clients that will just say, I want to be all invested on day one. That is probably 10% of our clients, if that much. Most of them are a lot more value conscious. And as a result, we'll tell them, you can hang on to the money, go invest it somewhere in money market or CDs, and then send us a chunk of money once a month. And we will build your portfolio over the next 12 months or maybe 24 months. But when you do send us money, we're only going to buy maybe one, maybe two, maybe three best ideas per month. And what we have found is that forces us to be more disciplined in what we're buying. We're only going to be buying our absolute best ideas. And I think that our entry point into those is more disciplined. And so it creates a real lumpiness short term because we only have a couple positions, but long term, the performance tends to be better. And it gives the client kind of a comfortable sense of, okay, we're not throwing all of our money into the market today. Then if the market does drop, like in April, I mean, we sent notes out to clients that said, if you have been sitting on cash, now is the time to send it to us. So there have been different times during the pandemic. We did that during 0809. We sent notes out to clients saying, if you've got cash sitting on the sidelines, now is the time to send it to us. And then we'll be much more broad in implementing portfolio trades to build out a portfolio quickly. But in a market like this, if it allows a client to sleep better at night by only taking a measured approach and do it a little at a time, that's fine with us. You know, in 10 years from now, I'm not sure that it matters a whole lot.
It's a fascinating phenomenon, and I don't think it's talked about enough because everybody's just celebrating new client coming in, but realizing what a huge ask it is and what a process it is to onboard and take it really seriously. And I see it the way you see it, which I would call planting seeds for the future success, right? So I don't buy the stocks that I've held for 10 years and they went up many times over, low cost basis, and clients are still holding them. I'm very hesitant about buying these. I'm buying the newer ones. So the performance in the first few months is very uneven, to say the least, because we're just phasing into something. But we're also avoiding, and funny enough, I onboarded clients minutes before the March 2020 sell-off, and I had calls with them. And I said, listen, I'm going to pace myself. I just came back from a conference in March, weeks before New York got completely shut down. And it was a picture perfect, you know, the best margins, the lowest unemployment, picture perfect. But there was something in the air. And I couldn't predict the pandemic. Of course, I had no idea, but there was something in the air. And I said, how about we give ourselves 3 to 6 months to phase in? And that really, really paid off in the coming months. And I had a similar situation with at least 2 new clients this year ahead of April. And I have, of course, had no idea what Liberation Day will mean. But anyways, those lessons remind me. You said one more thing about the evolution of a value investor, and I don't want to lose that thread. I wrote a piece recently. I called it Expensive Truth About Cheap Investments. And it got picked up by Wall Street Journal and one of the Canadian newspapers, which hardly ever happens, so I'm flattered. But I showed this idea, which I'm hearing from a lot of conversations on this podcast and from my own experience too. I'm as guilty as anybody else. We're drawn to value investing, which to me is basically paying attention to what you're getting and how much you're paying. And you can apply it across many, many different investments. But we come to investing because we're attracted to that idea that we get more than we paid. And we try to apply it across a lifetime of experiences. If Buffett had stayed a traditional Ben Graham net investor throughout his lifetime, I don't think he'd have the business that he has now. I'm gonna, that's my audacity to say that. He transformed to become, somebody that captured a lot more value creation in many more ways. I want to ask you about educating your clients, and you talk about it quite a bit, and I'm very curious. How do you prepare them for the experience? Because to you and I, seeing the prices go up, you mentioned the big ranges, but for somebody that comes in, they sold a business or they inherited $1 million, they show up at your door, it's not natural for them to see their net worth go up and down this much. How do you go about educating them and preparing them for the experience?
Yeah, that to us is a very interesting dynamic. Um, in following a portfolio, obviously we all have our portfolios on our phone. We have a ticker on our computers. We are bombarded by news all the time. And I've written an article about what the stock market delivers. And I really try and hammer this home to all of our clients. The stock market does not provide any level of audit or valuation. It just says if you need liquidity to buy or sell at any given moment on any given day, this is the price we'll pay. When you put it that way, most people, especially business owners, know that there's going to be tremendous randomness in the outcomes. And so, telling them and helping them to understand the stock market merely offers liquidity today. If you're a long-term investor, that may not matter at all to you. It might matter if we're placing trades in or out, but if we're truly long-term business owners, the ups and downs of what the liquidity market is doing should not impact us. And so we start by trying to offer that, and that helps them to dissociate CNBC and Fox Business News and breaking news and all of that, because none of them are providing a thoughtful analysis on any given business. Mm-hmm. And if we can show them our research and say, this is what this business has been able to do over the last 10 years, here's our projections on where we should be in another 10 years. That doesn't mean that we know what's going to happen over the next day, month, or quarter, or anything that short term. But I do think that we have some understanding of what a quality business will do over a decade. So we start there. And then, reading Morgan Housel has just been one of the greatest things that could have ever been provided to me. Because, here's this guy that really talks about, the behavioral side of how we live with money. And so we try and spend a lot of time finding the path that is going to allow a client to achieve their goals. And that's way different than maximizing performance. And helping people to understand with every portfolio, there is generally a liquidity component, a cash flow component, and a growth component. And then it takes a lot of back and forth. And again, the behavioral finance side of saying, how much money do you need in money market or CDs or treasury bills to sleep at night? And then, what are your goals 2, 3, 4, and 5 years from now? That's where the fixed income piece can come in. But once we get to 5 years and more, if we want to outpace taxes and inflation, we need to embrace the volatility of the stock market. When we phrase it like that, most people don't like the volatility, but they recognize what the long term delivers. And so that's kind of how we start. And it's very interesting, too, that trying to get somebody to understand that they're not swinging for the fence. We had a conversation with a client the other day. He spends way less than he could and never run out of money. And yet he's hoarding cash, but then he's comparing himself to, I had sent him the book, Richer, Wiser, Happier.
Wonderful book.
And yeah, it's a wonderful book, but he's comparing himself to people in the 1970s, Sir John Templeton, that were doing 30% a year, or Joel Greenblatt. And I'm just, trying to help him understand that on the one hand, you're wanting us to hold a lot of cash. That's your sleep well at night money. But you're then criticizing, saying that, why aren't we doing 30% a year? You're comparing two different philosophies. And so we will point this out to them and then take a step back and say, you have to educate me on what goals are most important, recognizing you can't be all cash or all stocks and be able to deliver ballast, stability, cash flow, and long-term growth. If you are either super liquid, one set of outcomes is pretty defined. If you're 100% stock market, you are going to be very volatile. And then the competitive nature of the stock market today is such that the people profiled in Richer, Wiser, Happier, they are probably never going to derive those returns ever again. Buffett has also said, don't expect us to deliver the returns we did in the 50s and 60s. It is just too difficult. And recognizing that, it's just, we are trying to educate our clients so they can make better decisions, because if not, they will react, they will act emotionally, and they'll chase after things. And, in managing portfolios, we kind of see two things that damage clients. It's either FOMO, fear of missing out, or the political environment is causing me to, the world is going to come to an end. Yes. And we've seen both. The market's had a nice run, and now all of a sudden people have to chase after whatever this hot stock was. For some reason, we've been asked about nuclear stocks like 5 times this week, because they all hear the nuclear talk, but they don't recognize that that may not be a good investment. It may be popular discussion, but it's not a good investment, or in limited quantities. And as far as the political environment, we've had a couple clients that have pulled significant amounts of their net worth out of the market this year because they don't like the political environment. And we have to help them understand politicians don't run businesses. In Texas, we have a grocery store called H-E-B, and everybody knows it. It's very iconic, but it's privately held, which means nobody's checking the ticker symbol. And I just like to ask clients, if your candidate for president does not get elected, does that mean that the produce manager at the grocery store is just going to throw up his hands and say, we're not going to stock produce for the next 4 years? That would be asinine. And as a result, we try and get them to understand that capitalism is a brutally competitive business, but every capitalist and entrepreneur we've ever seen that is going to survive long term, they are in it to win it every single day, regardless of political regimes and the day-to-day of the news cycle. Trying to get them to understand we are owning businesses that succeed in good markets and bad, good politicians and bad, trying to undo a lot of the preconceived notions that they bring to the table. And again, we do so respectfully, but with an awful lot of education so that they can understand what the plan and the process is. If we do that, they're probably going to be difficult clients initially, but for the next 10 years, they're going to be much better off, and they'll derive better results too.
So many golden nuggets here, but there's this saying that the stock market is not the economy is not the stock market. And I think there are moments where we walk out, we look around, especially during the pandemic, we thought the world stopped. And on TV, people would say the economy stopped. Did it though? Most of it continued to function. And right. So that was one thing. The political side, I think it's a very fascinating topic. And Barry Ritholtz was on the show, and he wrote a great book lately, and he brought it home for me. And he has all those studies and stories that I can't retell. But if you just ignored who got elected, your portfolio would thank you. I think that's the simplest way to put it. And I think we spend a lot of time and energy. I think, it's a democracy. We can go and vote. Once you're done with that, go focus on your portfolio and let your businesses in the portfolio do the work. And they'll do just fine, no matter who is in the office or not in the office at that time. I think it's a great lesson. FOMO, I don't have a recipe or a medication or anything, but other than, I think, JP Morgan, not the bank, but the person told us, I think, over 100 years ago that no more money was lost by watching the neighbor get richer than you, faster than you, because you chase things that you shouldn't be a part of. And I think JP Morgan was right about it. And let's not think that Bitcoin or whatever it is of the day, the phenomenon is as old as our human experience. So there's a lesson there. I want to ask you about the Bulldog Investment Company. How did it come about? What's it all about? I know you're having a lot of fun with it, but tell us more.
Yeah, so I went to Texas Lutheran, as did much of my family. And shortly after I graduated, I served on the business department, has its own independent advisory board. And the goal is just to meet twice a year to work with the faculty, business leaders offering input about industry trends and what kind of skills do students need to have coming out to be competitive. And and then how do we custom tailor curriculum to facilitate that? And so in the spring of 2009, we had a meeting and it talked about the importance of internships. And I started thinking about that. I run an investment firm and we read 10Ks and we break down financial statements. And I just started thinking, is there an internship in there that I could create? And I recognize I live almost 2 hours away from the university. So a bunch of students coming to my office every week during the school year was not practical. And so I pitched to the university, to the business department. I said, would you guys mind if I tried to create an internship that basically teaches kids how to break down financial statements? Because whether they work for a big Fortune 500 company or a small entrepreneurial endeavor or a nonprofit, they all produce financial statements. And if they understand financial statements, they'll be more valuable to their coworkers, to their bosses, boards of directors, and shareholders. And it seems like it's such a valuable skill. And then, so they were very receptive to that. And I asked very little of them. I just said, just refer me students and give me a classroom to meet in. And so there was very little downside to the university and lots of upside. And so we started that. And over the summer, I had a couple of kids who were helping me outline Warren Buffett type books or the little book on value investing, things of that nature. And when the fall came around, fall of 2009, we recognized that just analyzing financial statements, that's a pretty unique skill set on its own. So we put it in a Buffett flavored wrapper. And I said, we'll split the class into teams of two, and each team will go research ideas that they think Warren Buffett would be interested in investing in. So there's a pitch to a professional board of directors. And they have to do all the breakdown of financial statements. They have to identify the competitive advantage. They have to evaluate return on equity, return on capital, do full DuPont analysis, and really a deep dive into the leverage that operates inside of the organization, and then be able to value the business. And I would like to tell you that it was that fleshed out on day one. It probably took, several years to really get there. And every year we just make incremental improvements to it. And so like that first summer, I had 3 students. And in the fall, I had 5 or 6 students. And then I had 8 students. And today we run probably 20 to 25 students. I'll have somewhere between 8 and 10 that are returning students. Many of my students have been in the program for 4 and 5 years. So initially, I told them, okay, I need a commitment of 2 semesters because of the high learning curve. And then the kids that were there, they were like, well, we don't want to leave. Like, okay, well, I'm not going to kick you out. If you want to keep coming back and put up with me, I'm happy to have you in the class. And what I recognized were I was teaching the students, and the students with the best tenure then became teachers to the newest students, and they became mentors. And taking that several years down the road, once we started having graduates, we have a website that hosts the LinkedIn profiles of every student who's ever been in the program. And so it's got their LinkedIn profile, what year they graduated, and what their degree was, so they can track them down. And now we have our alumni come back and lecture also, but they also serve as mentors. So if a student is going down a certain path and they want to know, what is that job like when I come out of college? They can hit up one of the alums from our program and say, can you tell me what this looks like, what the skill set is, and do you have any recommendations for me? Mm-hmm. And as a result, it's become a flywheel of success. So it's just, that was the inception, was trying to teach kids financial statement analysis, and and then put it in that Buffett wrapper, it's grown to way more than I ever could have envisioned.
I find it fascinating. I've had interns over the years, and the questions they ask make me a better investor because they come with such a fresh mind. They're fascinated with something, just the way I was when I picked up One Up on Wall Street by Peter Lynch. I had a million questions about how this phenomenon works. How can you buy businesses? And to me, it was such an eye-opening experience. I had Chris Beck on the show, who teaches the original security analysis class at Columbia. And Chris is a good friend, and he was kind enough to invite me to listen and sit in the back of the classroom when he had a few guests speak to students. And Nick Sleep came to talk, and I really enjoyed talking to him. Nick Sleep is a legend that people can look up his letters and I think find a lot of inspiration. But I told Chris, everybody in this room is here because they really, really, really want to be in this room. And that class is oversubscribed. I imagine that your class either is or will be oversubscribed soon, maybe after this podcast airs. But what a feeling as a teacher to have people that, however many, they really want to be in this classroom. I think it's a wonderful thing. Dave, I want to ask you, it's real money that they invest, don't they?
Mm-hmm.
Tell me why that's important.
Yeah, so when we first started, I've always let the students play with my own money. I realized that if I went to the university and said, hey, this is a completely unproven concept that I'm bringing to you, but could you carve off 10 or $20 million of the school's endowment? They would not have gone for that. And so I just thought, let's just start modest and see how it works, and I'll just have them manage my money. And so my initial agreement was that for whatever the winning presentation was, that we'd fund it with $5,000. And so that was where we were initially. And over the years, it's grown quite a bit. And so today, trades are routinely $100,000 or more dollars. And as a result, students know every single week what their positions are, how big they are, what their percentage concentration is. They manage right at $2.3 million. And as a result, they know it's real money. And they also recognize real money, good decisions have good outcomes, and bad decisions have truly, consequences. And so recognizing that and hopefully not blowing up too much, I can't think of a single time where they have blown anything up. There are some times where they may not make the optimal decision, but that just becomes another learning opportunity. So having the real money, it forces them to think through, how much are we going to buy? How much is this going to be part of our portfolio? How do we rebalance if we do, or do we just let it run? When it's real money, it forces their eyeballs to be very trained on what the outcomes need to be and making sure they stay on top of all their research assignments.
There are consequences of decisions in investing. And when you have the face of the person in your mind, when you're making that decision, it's a whole different decision. I want to bring up a quick story. I had Guy Spear on the show, who you know as well. And I asked him a question that I've been dying to ask him over the years. People can look up the episode, but I asked him the first money he invested professionally, seriously. It was the money that his father gave him to manage. And Guy told me something that every time I bring up this story, it gives me chills. He said, I was shaking. It was his father's money that took years to build. And the money that you're investing, I'm investing, it took years to save, invest, inherit, and, compound. It took years. So if you're not shaking a little bit, I think you might be in the wrong profession. You should feel the responsibility that comes with it. And the quality of the decision rises so much and so fast when you realize it's a real person's livelihood on the line. I can't unsee it. Once you realize that, you can't unsee
right. it. And I agree with you. That's probably been one of the learning curve type items, is that the students are so concerned about making a mistake because they do realize it's real money that initially, you've either got some that are too bold and then you've got others that are way too hesitant. And that's why having some older students that have been in the program, they can counsel them and say, this will be okay. Here's why it will be okay. And of course, I'm there teaching every week, and then some of my employees are former students of the program. So like 8 out of the 10 people in our firm on the investment side, they were all TOU graduates. And so they've all been through the program. They remember having those butterflies in their stomach. And I just tell them, if your stomach's not churning a little bit, you're probably not doing it right.
There's truth to it. It takes a lot of temperament and emotional makeup, but at the end of the day, you have to realize what a huge weight it is on your shoulders to be responsible for other people's money. There are many other ways that you can go about your professional life without taking that kind of responsibility. So it's a higher calling in my mind to be doing this. I want to ask one more big question that's been on my mind. You might know that I manage money for families, many cases multi-generational wealth, or families that aspire to have the wealth that they created in this lifetime to last multiple generations. There's a certain transition that happens, and we kind of touched on it throughout this conversation, but I want to highlight that. And when I say transition, people picture a 20-year-old that receives an inheritance. It's not really the exact picture these days. It might be a 50, 60-year-old that receives an inheritance much later. And they already had a successful career in whichever field they picked. Might not be financially successful, but very fulfilling. And here they have this life-changing experience. My good friend and mentor, Jay Hughes, talks about this integration. How do you integrate this phenomenon of wealth coming to your life? Can you talk about that next generation? We can talk about the 20-year-olds, but I'm also curious about the 50, 60-year-olds. And there will be more of them in the coming years because their parents are passing away much later. And the inheritance will come at a point in time where I don't know if it's harder or easier. It's different to integrate it to your life than it would have been at 25.
Yeah, that is a really thought-provoking question, and it's one that we experience. If we're working with an entrepreneur and he is putting his children to work in the business, okay, and they're 15, 16, 17 years old, you're getting them at a very young age and trying to be very thoughtful in teaching them about what the future looks like. But you are right that if somebody doesn't come into that position until 50 or 60, I remember, one of my favorite clients of all time. He was a World War II veteran, and he had high school education, maybe just an 8th grade education, and he had a business where he sold paper forms to businesses in the area. He lived in the same house for 50 years. He drove used cars, and he played golf at the public course. And he would gamble for a nickel a hole, which I thought was pretty funny. And one day his son, who was already 50 some years old, found out that his dad, who was very frugal, very practical, invest and reinvest, he just enjoyed the investing game and he enjoyed seeing the balances go up. He didn't deny himself of anything that was necessary in life, but his son started to realize that his dad had a portfolio of $5 million. And he's just like, I can't believe my dad didn't just go buy a new car, or why he doesn't fly first class. And I just said, Danny, you have to understand that your father has been this way ever since the first penny he ever got. And he had to be very careful with it. And he invested it and reinvested it. And those, when Buffett says, habits are too, habits are easy to break. And then when the chain becomes too big, you're stuck with them. I know I'm getting that wrong, but basically our habits form over time, and they're very light initially. But once they're formed, you're not breaking them. Mm-hmm. And so this client, Bill, he didn't just wake up one day and say, I've got $5 million in the bank. I think I'm going to behave like an idiot now. And his son, who had never been a good investment manager for his own household, he just couldn't conceive of the discipline and the time it took to accumulate that. And the son is now the one who's managing the money, and it is different. Mm-hmm. And so we try and help him to understand what it took for his parents to accumulate that wealth, and then once mom and dad are gone, how do we apply this pool of resources to you and your family? How do we identify what's important to you, recognizing that, yeah, we can spend an awful lot of money for a short period of time, but if we blow you up, then all of a sudden you're having to get another job or come out of retirement or things like that. And so you are right. It's different, and it's just a very interesting dynamic when generational wealth passes from one generation to the next, especially if they haven't been brought in early enough to understand how the wealth was accumulated.
I have so many thoughts, but I'm going to be fast. To me, it's this huge realization how precious that capital is. You said 5 million. Let's play with that number. How much time it took, how many times your client had to say no to certain things, the discipline as you highlighted, right? And also when you think about the time it took, the effort it took, that money, once it's lost, to replenish it, it's almost impossible. And when I work with clients, we talk about the money they don't immediately need. I think it's very important if you want to invest as a long-term patient investor, it has to be money that you don't immediately need. It's not the money for the car, for the kitchen, for whatever you need, or a new house. It's the money you can let be for a period of time. But this other realization is the money that you cannot afford to lose. If I come across somebody that calls me, sends me an email, and I realize that they're still at that stage of life that they think they lose $1 million, they'll make it back, I might not be the manager for you. I have this realization. You have to come to this eye-opening moment yourself that if this is the money you cannot afford to lose, then we can have a conversation. And I want to highlight one more thing. You and I traded emails about it. I wrote a piece about invisible wealth. And this phenomenon that I think on so many layers, and I just peeled some layers of it in that piece that I wrote, but that you and I could go to dinner and one of us or somebody in the room could be the richest person at that dinner, and there's no way of telling. And back in the day, in this imaginary 1800s, 1900s world, you would know who is the richest person in town. And you were talking about the community. I grew up in a small town too. You would know who the richest person was. There was a big brewery at the end of town. There was a big manufacturing plant. You would know who the richest person was, or your friend was selling forms to businesses. You would know. But today you could quietly have, and I've met so many people because of this podcast that reached out to me and we talked on Zoom, who have eye-popping amounts of money, but living very modest lives and have no problem with it. And it's not that they're living this hardship of a life that they say no to things. It just gives them comfort that the money is there. And you would never know that they can buy the entire dinner for 12 of us and it would make no difference to them. You just don't know. I think there's something to unpack here. I think it's a huge advantage too. It might be tricky to interact with, but the fact that it doesn't have to have an impact on your social life, even if you have a $5 million portfolio, nobody has to know. For whatever reason, I think it gives me some comfort that you could have that kind of invisible wealth. Now, a whole different thing. You could surprise your kids because they have no idea. And that's a whole different thing to process and prepare. Dave, I could keep you here all day. I have one last big question. How do you think about success?
That's a good question, and I think it's one that is in process. Um, I don't know. For all of us, success is the kind of thing that you should be working on it your entire life. We have a document in the back of our office that I will share with my students, and I've shared with our distribution list. And it basically just says if on each day you have access to water, food to eat, a roof over your head, access to health care, and nobody is shooting at you, you're a long way down the road to being successful and very lucky. And then if you're also fortunate enough to live in a capitalist society and you can pursue any career you want, that's just another leap towards success. For myself, I have financial flexibility to pay my bills. I have a career in which I'm surrounded by people who are both funny and smart, much smarter than I am. I have a good marriage. It's not a perfect marriage, but it's one in which we have fun together. And when we butt heads, it's the kind of thing that causes us to be better. I also have a group of friends that have been in my life for 40 plus years. And they pass what I call the 2 a.m. test. And that is, they can call me at 2 a.m. and say, I need help. And if you start giving excuses, that tells you what kind of friend you think they are. But if you just say, I will be there as soon as I can change my clothes and get in the car, that tells you something else about that relationship. And so these friends that have been with me since long before I was ever successful in any stretch of the imagination, they still will accept my phone calls and say, how can I help you at 2 a.m.? And I would reciprocate. When you think about success, that's not something you necessarily put on the wall, but those are the things that I think are really important. When I think about our firm, we have clients that are engaging and we get to solve difficult problems for them. They're fun puzzles to work on. I love my work. I am an admitted workaholic. I love being at the office 7 days a week. And then when I die, my estate will go to charity, and hopefully they'll do some good things. And so when I think about things, I'm 58 years old. I'm still in relatively good health, have a few issues here and there, but I recognize I'm just incredibly fortunate. And so hopefully that means I'm on my way to success. Hopefully that means I'm valuing things that really matter. And hopefully I can keep living this life for another 40 years. So, maybe I can keep enhancing students at TLU, hopefully the people in my life. And when I'm gone, hopefully I can leave a meaningful legacy that others can do something with to help those that have been less fortunate.
I love the sound of it. It's all about people and relationships. It's the biggest capital, for lack of a better word, that we can accumulate in this life, to have people you can call at 2 a.m. and say, I need you, and they'll be there. Dave, this was such a wonderful conversation. I'm so happy we did it. I knew a lot, but I feel like I know so much more about your life, the career you've built, the people in your life, and how you're serving your clients in such a thoughtful way that I think we all can learn from. So thank you so much for today. What a pleasure.
And thank you for the invitation. It was really a lot of fun. You asked very thought-provoking questions.
Before you go, just a quick reminder. If you want to check out Fiscal AI and see how it can upgrade your research process, subscribe using the link in the show notes to get a free 2-week trial plus 15% off. You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.